We've looked at the calendar, earnings, and the futures. Now let's tackle one of the most debated seasonal questions every spring. Should you sell in May and go away in 2026? The old adage suggests stocks tend to underperform in May through October compared to the stronger November-April periods. Historically, there's some truth to it, but the data in the recent years, and especially right now, tells a more nuanced story. So, here's a historical case. Since 1950, the S&P 500 has averaged roughly 7% gains from November to April, but only about 1.7 to 2.1% from May to October. Midterm election years like this year have been even weaker on average. For the last 6 month stretch, negative in about half the cases with modest average losses. Sounds compelling, right? But with blind adherence has some costly mistakes lately. Look at where we are right now. Crisis is not done. Crude oil futures are elevated. Stock market is still up. So we're not getting the traditional response and reactions that we usually get in these situations. People aren't piling into gold or silver. The stock market isn't bleeding out because of the overall cost of energy going up. Who knows what could be happening? But recent performance will kind of prove or disprove why the sell in May looks outdated this year. Over the past 10 to 12 years, May through October returns have been much stronger, averaging about 5 to 7%, with positive results in most periods. May itself has been positive in 12 of the last 13 years. We're coming off a massive April, 10% plus, with the S&P 500 near record highs, strong Q1 earnings momentum, AI tailwinds, and resilient growth are supporting the bulls. Many strategists may say blindly selling now would mean missing out on potential upside. Like we talked about Friday and earlier in this pod, we have SpaceX IPO coming out soon too. That itself could be extremely bullish for this coming June and help the S&P 500 grind higher on rocket themes all summer. Who knows? Algorithms don't take summer vacations, and structural drivers like AI, space/tech IPOs, on-chain growth don't follow a calendar. Sticky inflation, oil geopolitics could create summer volatility. Midterm years have seen weakness before, and August through October is often the roughest patch historically. A healthy consolidation or a pullback in May wouldn't be surprising after April's huge 10% plus surge. So, here's a takeaway. Don't sell everything and go into cash. The people who have been doing that have been getting their faces kicked in, just sitting there, missing out on historical moves. It's rarely the winning move anyway. In today's environment, instead of sell the May, as a risk management reminder, trim winners, rebalance, rotate into defensives or hedges if you're overweight, and stay selective. Often on quality earnings stories, watch for Fed minutes and oil. Focus in those areas and be ready for dips to buy rather than a mass exodus. That is a fear-based response. What are you afraid of? A little bit of downturn? That's what we're in here for. That's why we play the game. Get selective, get defensive, rebalance. Look for things that might be a little bit overweight. If your portfolio tends to swing a lot with the markets as we're dealing with, it's only going to get worse. So it might be time to trim the winners and reconsolidate that or diversify that into something that could be defensive against the overall market that we're dealing with. The market doesn't care what month it is. It cares about earnings, rates, and geopolitics. In 2026, with powerful secular themes in play, staying invested with discipline looks much smarter than following any old ridiculous rhyme.